Thanks very much, David. Good afternoon, ladies and gentlemen. Benjamin Franklin, under a time of great stress in 1776, said, and I quote, "We must indeed all hang together, or most assuredly we shall all hang separately." And I kind of think that's good advice for the EU leaders when they're thinking about the euro area. I guess what I'd like to talk about today is what's gone wrong with the single currency in Europe. Why is monetary union in Europe in crisis, and what can policymakers do about it? And one thing that the crisis has made clear about the euro area is that the euro area is not really a genuine monetary union at all. The United States is a proper monetary union. It's got 50 distinct states that successfully share a common currency. The US is a genuine monetary union because the dollar, their single currency, is underpinned by deep financial, fiscal and political integration across the states. In the US, banks are supervised and regulated at the federal level, including by the Federal Reserve. But as David mentioned, I used to work at one stage. Bank deposits are guaranteed by the federal government, not by individual states. So if you live in Virginia, it's not the Virginian government that guarantees the safety of your bank deposits, it's the US federal government. And the costs of bailing out banks, if banks fail, is shared across the US states. If you live in Virginia and a bank goes wrong, it's not the local government in Virginia that bails out the bank, it's the US government. So in other words, the United States is a banking union. The US is also a fiscal union in that money is automatically transferred via the federal government to states that are temporarily doing badly from those that are temporarily doing well. So if you live in Pennsylvania and something bad happens, automatically money gets transferred to Pennsylvania from everywhere else, and that happens through the federal government. That's a fiscal union. So if you think about in the US, the state and local governments cut spending very sharply in 2008 and 2009 as the recession hit, but the depressing effects on economic activity of those cuts were offset by President Obama's fiscal stimulus at the federal level. In Europe, the common EU budget is only about 1% of GDP, of EU GDP, therefore it's too small to act as a counter-cyclical force in the face of fiscal tightening at the national level. So in contrast to the monetary union of the United States, what we have in the euro area is a collection of 17 distinct sovereign, political and financial systems that use the same currency. The Delors report of 1989 and the European Commission's One Money, One Market report of 1990 outlined a policy framework for the euro which European leaders hoped would deliver stability, promote economic convergence and boost growth. So that the creation of the euro itself was expected to spur closer financial, fiscal and political integration across Europe. But when we look back at it, certainly over the last decade, little progress has been made on those fronts. In fact, in the last few years, things in many ways have gone backwards. The markets through which banks in one euro area member state lend to banks in another has essentially collapsed. It just doesn't function anymore. The interbank market in the euro area has collapsed. The crisis has led to European financial disintegration. We've gone backwards. Today, German banks lend money to other German banks, but not to Italian, Irish or Spanish banks. As a result, the European Central Bank has had to take on the role of the European interbank market. The ECB is now the interbank market. The ECB borrows money from banks in creditor countries and lends it to banks in debtor countries. The Van Rompuy report, which was released last month, provided a glimpse into the future of the euro. The report formed the basis for the latest EU Leaders Summit, which concluded on 29th of June. And what it did is it set out a blueprint for a fully fledged monetary union in Europe. It's likely that few, if any, of the report's ambitious proposals will be introduced in the near term, and some of them may never see the light of day. But if the euro is to survive, then the report is a roadmap showing where Europe must go. In other words, Europe must have a banking union. The Van Rompuy report seeks to create a real banking Europe in Europe, like they have in the United States, and without that, the single currency just can't work. A banking union, why is it essential? Well, it would go a long way to ending the toxic interrelationship between sovereign debt and banking crisis that has been one of the key underlying causes of the euro crisis. Unlike in a banking union, each euro area member state is responsible for rescuing its own banks. As I pointed out earlier, that's not true in a real monetary union like the US. It is worth contrasting that with the US federal government's TARP, or Troubled Asset Relief Program, in 2008 and 2009, which recapitalized US banks using federal money. In addition, banks in each euro area member state own a disproportionately large amount of sovereign debt of that member state. So concerns about national finances can significantly affect balance sheets of banks in that member state. That is not true in the US, where banks own federal debt, but not the state debt. It doesn't have that toxic interrelationship. The EU latest statement of the 29th of June included a commitment to take the first step towards a banking union. If EU leaders make good on their promises, we will see the ECB eventually taking over responsibility for supervising banks in the euro area from national supervisors, and the euro area's fund recapitalising banks rather than member states. And we might see eventually euro area-wide guarantees of bank deposits. But one thing is clear, that that's only going to happen gradually. It's going to be a bumpy road to that banking union. One question to ask is, and the topic of this particular session is whether we need a fiscal union. What I've been talking about so far is a banking union, much closer integration than banks. Do we need something much closer integration on the fiscal side? I think the answer is we do, for two reasons. The first is that a banking union, which is absolutely required for the single currency to work, requires governments in the stronger economies to put their taxpayers' money at risk to support banks in the weaker economies. And that's a big ask. As a government in one member state has very little information about and even less control over the banking system in another member state. So that is why a banking union must surely go hand in hand with a fiscal union. In turn, a fiscal union, which potentially involves large transfers between nation states, is unlikely to be sustainable unless it has political legitimacy. Germany in particular remains reluctant to move far in the direction of a banking and fiscal union until there is much closer political integration in Europe, involving large transfers of sovereignty to Brussels. This is what Angela Merkel means when she says that the solution to the crisis is, and I quote, more Europe, not less Europe, unquote. Other euro area governments want to sequence things differently. But it's not just that the German politicians are worried about German taxpayers' money going to Southern Europe. There's also the issue of the German constitution, which seems to rule out a lot of the proposals that are doing the rounds. I think it's fair to predict that progress will be slow. A second reason we're going to need a fiscal union is that because progress will be slow on the banking front, the euro area crisis is going to continue, and therefore euro area economy is going to continue to contract. So there has to be some solution brought to the stress in financial markets, and what markets are looking to see, at least in the short term, is whether the EU leaders can agree a shared vision about where the euro area is going, even if it takes a long time to get there. An agreed blueprint for a genuine monetary union is necessary for the euro to survive, but it's not sufficient. At current interest rates, neither Spain or Italy can afford to borrow from the markets. Their interest rates of more than 6 and 7%. And there's not enough money in the EU rescue funds to bail them both out. So the euro is heading towards a cliff. What's needed is an immediate game changer. And the only institution that can turn things around quickly is the ECB. One thing, thinking back to the US again, the genuine monetary union, after the Second World War, America's central bank pegged long-term interest rates in the US at about 2.5% by committing to buy an unlimited amount of US government debt. In the event, the Fed managed to keep the US borrowing costs low without having to buy much debt at all, because the Fed's commitment to do that changed market expectations. Something like that, it seems to me, is going to be required in Europe, and ECB is going to have to, in some way, stand behind the European bond market. It's hard to see how growth will resume in Europe unless the financial stress is eased, and without growth, things are going to go from bad to worse. The euro area at the moment is currently solvent. What I mean by that is the euro area as a whole has less debt than the US does. So the euro area is solvent. But unless growth resumes, then the euro area itself is heading towards insolvency. It's not a coincidence that countries that have central banks that stand behind their governments, the US and the UK, have very, very low long-term interest rates. So we're going to need to see more aggressive monetary policy in the euro area. One consequence of that is that it'll probably lead to a steep depreciation in the euro. In fact, one of the things we've seen over the last few weeks is the euro is getting weaker, and that's one of the reasons the markets are beginning to look somewhat more favourably in Ireland. A weaker euro would boost the euro area exports. Ireland would especially benefit from a weaker euro, given the openness of our economy and our close trade links with the US and the UK. Of course, we'd also benefit from a stronger monetary union. Let me just finish off by saying one of the other benefits of a move towards a banking union for Ireland, we think about the implications for Ireland, is that it was always going to be the case when we think about the rescue programs and the institutions and policies in Europe, things would have to change, steps towards a banking union. And they were going to benefit Ireland in the sense that Ireland would then be able to look at the programme at the moment and look at the way Europe interacted with Ireland in the programme and say that Ireland needs some sort of compensation for the fact that when Ireland was trying to rescue the banks, there was no banking union. Let me finish by saying that most of all, we would benefit from an end to the crisis in Europe, which at the moment is the main factor holding back our economic recovery. Thank you.